Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Ari.
Hello.
Thank you guys for joining us in the second episode of Joel Greenblatt's Magic Formula. In this episode, we're going to be talking about how to actually use this magic formula in practice and how Joel Greenblatt himself might use this formula in his investment practice. If you haven't listened to our previous episode, we talk about what magic formula is, why is it important, what is the formula. We talk about those stuff in the previous episode, so check that out before you listen to this one. All right. Before we move on and dive into this one, could you give us a disclaimer, Hari?
Yeah. So this is the Value Investor TV podcast. We are here to help you learn how to invest like value investors would. We are not financial advisors. We don't know your specific financial situation. So before making any investment decisions, if you need to, contact a financial advisor and to go over your specific financial situation.
Awesome. Hope everyone is doing well. 4th of July is approaching. It's time is flying by. We're recording this podcast on June 29th, so I'm not sure when this will go out, but 4th of July is approaching. I hope everyone is will enjoy their 4th of July weekend, or have enjoyed their 4th of July weekend if it goes out afterwards. Okay. Let's get into this, Hari. How should we start this? Should we give our listeners a small kind of summary of what we talked about previously, what the formula is?
Yeah. Why don't you tell everyone what the formula is, just in case they've, forgotten from the last episode.
Sure. Yeah. So, as value investors, we like to look at good companies that are cheap. So those are two different measurements that we look at for companies. A company could be a cheap company, but it could be a horrible company. So we want to look for cheap company that are really excellent. And so to measure these two different things, Joel Greenblatt has two formulas to look at the how cheap a company is, and also how good the company is. So the first aspect, the cheap aspect, is he looks at EBIT divided by enterprise value, EBIT divided by enterprise value. And the second formula, how good a company is, he looks at EBIT divided by capital employed. And so those are at a high level what the formulas are. If you want to learn more about exactly what they are, we talked in detail about these respective formulas in the previous episode, so do check them out.
Yeah.
Okay, should we get going and talk about how these formulas can be used in practice?
Yeah. So if you are, if you're on YouTube, you can see the book that talks about this, called The Little Book That Beats the Market. And there's a follow-up to it called The Little Book That Still Beats the Market, down there by Joel Greenblatt. So I'd highly recommend reading it because it's very short. It's only about 120 pages. And he kind of explains that formula in detail. And then he actually also explains how he uses it, or how an investor would use it in practice, right? So in the book, what he says is he's trying to make this formula so that a person who doesn't have time to invest can and research stocks can actually go and find 30 companies, buy 6 or 7 of them per quarter, and then hold them for about a year, right? So he essentially what you're doing is taking your money, investing a small amount of it, in chunks every quarter, holding those companies, for about a year, and then selling them 1 year later. And then based on whether they are losers, you would, sell them before the tax year is up. And if they are winners, you would hold them for one more day than in a year, so that you would get capital gains benefits. So, the idea that he is proposing with this book is really more around an investor who is not doing any of their own, homework, you would own, between 25 and 30 stocks using that, and you would kind of reduce your risk associated with each, with this, because you've kind of spread out your money over 30 different businesses, right? Mm-hmm. So I think it's a fine approach to do it that way. But, I think in practice, the problem with that is that there is some, there's 30 companies that you have to buy. Let's say you only have $10,000, you're only putting in, a few $100s per company, right? And you may have some, big winners, you may have some marginal ones, and you may have some losers. And so, there's, and with that amount of capital, unless you're in a, if you're paying $7 or $8 per transaction, that those fees can actually eat into your portfolio there, right? I don't think there's anything wrong with doing this approach. I think it's totally fine. But, for our purposes, I think the podcast here, we are trying to help you learn how to invest for yourself by buying companies. And, if you can't, the alternative is to do what Greenblatt suggests with 30 businesses, or buy an index fund and just use that as a passive way to make decisions. But if we were kind of thinking about how Greenblatt would do this in practice, right, I think Greenblatt probably holds much fewer than 30 stocks. I've seen him talk about this in various things. I think he has some lectures on YouTube. I think he has a few lecture notes that you can find from his class in Columbia. And I think he owns like 5 to 8 businesses, and he actually doesn't own them for a year. He'll hold them for, longer than that, 3 years to 5 years, depending. So he has a much more concentrated portfolio. And so between 5 and 8 companies is about 10 to 12%, 10 to 20% of your portfolio in each individual business. Which is, some would say is a lot, some would say not. I think those are, it's all dependent on your ability to understand that. But what he's really doing is he's using the magic formula to screen out and give himself a list of companies that he then goes and reviews, right? And then he's reviewing those with a checklist or however he does it, and identifying the ones that are really truly the best of the best, right? That he can see some clear value in them. They're not, their businesses aren't eroding. He can see that they're going to grow over time, right? Because even though some of these companies are good and cheap, they still may be value traps. They may have a lot of debt. They may have other things that are creating them. So, imagine if you have a company, we talked about the enterprise value of the business. Well, if the stock is trading at 2 cents a share and it's all in debt, right? 100 or 90% of the enterprise value is in debt. Well, that's not necessarily a good business, right? Like It may have a good earnings yield, but it'll be going to bankruptcy, right? So it's not an indiscriminate purchase of companies. I think he's looking through the businesses and seeing which ones will be good in the next 3 to 5 years that'll have some, so he's actually investigating the underlying business itself, and he may punt on it because, it's too hard or it doesn't have the, so using that same checklist that we've always talked about, you can get kind of a filter, of the companies. So,
I think, obviously, one of the things that I brought up in the previous episode is that Joel Greenblatt is a big name value investor, and his performance, if you look at it, since 1980s to the early 2000s, his return has been 40%. 40%, compounded annual growth rate of 40%. That's insane. That's an insane amount. That's an insane level of growth.
Right.
And, he uses these approach, like we talked about, Hari just talked about, with the magic formula to filter out the companies that have really good value at a discounted price. And then he reviews them with his own checklist, or, with his own investment team and things like that. But this is, again, we believe this is a filtering tool to allow him to focus on companies that he thinks has potential. It is not a tool to make, basically just push the decision to the filter itself. So if this is just a filter to get 50 to 100 companies that fit his investment decisions, and from there he will review. And I think that's how people should use it, and that's how Hari and myself, have used it before.
Yeah, and I'll give you an example of a company that I found using that. And this was in 2008 or 2009. I found a company called Accenture. So Accenture is a IT services firm. They are like consultants like Deloitte or KPMG. They provide, but they focus on the IT space. So if you're at a Fortune 500 company and you're trying to roll out a Office 365, they'll hire Accenture. They'll come out and install, train, support, all of those things. So it's a services business. They had a very high return on capital, and they had a very high earnings yield at the time, because this was right around when the market crashed several years ago in 2009. And I bought the company and I held it for about 8 years. And it was an 8-bagger for me. I made a nice chunk of change. It was a very easy investment to make. And some of the other businesses that I had bought at the same time, did not turn out so well. I mean, they had it was a tough time in the market also because of the macro environment that we were in. But Accenture had a consistent company. They were doing very well. It was a very easy investment to make. And if I had been more in tune with what I was doing at the time, I would have probably put more of my asset allocation into Accenture instead of distributing it amongst 5 or 6 different companies that I didn't know as well. Right. So part of this is also understanding, like, when I'm putting all my eggs into a basket, I'm going to watch that basket and know exactly what's in that basket. Right. I don't want to just indiscriminately buy things. And if I do that, then I need to be distributing my risk amongst many different companies, right? And so one of the things that I found over using this, because the book is around 15 years old, I would say at this point, there's some really fantastic companies that appear on the list. There are also some huge duds on the list, and you've got to kind of go through there and look. I think I looked at this maybe 3 or 6 months ago, and GameStop was one of the companies on the Magic Formula list. And
yeah, I
mean, I looked at it. I'd passed on it because I knew it was a lousy business as a value trap, right? But I think it was good when we actually did the podcast on it to kind of reinforce what I knew already about it. But that's what I want to make sure everyone understands is, if you're going to use this, it is not a indiscriminately buy whatever appears on this list. It is, this is how I find businesses to look at. I can't know 5,000 companies on that are being publicly traded, but I want a list of maybe 50 or 100 that I can start perusing, right? And that's how I would look. And what I would do is I would screen for companies that have a high return on tangible capital, the return on capital employed of, let's say, 50% or more, right? I don't want companies that are 10 or 15%. I want it to be very high. And then I want an earnings yield of about 10 or 15%. So, we have a database that Becco and I play with that we've personally created. And we have a Magic Formula screener built into it. And I think we did a back test just this week, in preparation for the podcast. And since 2000, the Magic Formula would have returned us about 24.5%. So, it's fantastic returns, right? This is using those same cutoffs I just mentioned: 15% earnings yield, 50% return on capital employed as the minimum, and then picking companies off of that list. If even if you didn't pick the companies off the list and you just bought all of them, you would have gotten a 25% return. Yeah. So
that goes to show the power of Magic Formula.
Yeah.
And I want to give you a little plug for our database. This is something that we have been working on to make it available for our listeners. So Yeah, this is a website. It's a web application that we're trying to build out, and we want to make it available for our listeners soon. So just keep on the lookout for a message when it becomes available. With the filters and all the publicly traded all the publicly available information about publicly traded companies should all be available in the web application.
Yeah, and if you want to get on a mailing list, to be told when it does come out, you can send us an email, info@valueinvestor.org, and we will happy to notify you when it does become available, so that you can start using it. But getting back to the formula, I think it's a really powerful thing, because what you see is there's a lot of businesses that meet the criteria that are, they're just bums, right? You're going to have to figure out which ones are the bums in there. And taking GameStop as an example, I just don't understand it. It's the business as it is today is eroding, so I don't want to be involved with it. But the other companies that are on that list, you may not have heard of them. You go in and investigate, kind of understand what they are, and you say, yeah, this is a great business, and there's nothing wrong with it, and that's a potential investment right there. So I really think this is a great way to screen. It's a great way to do your portfolio, and I don't think it really requires... if you're a beginning investor, it's a good place to start, because you can start screening quickly down to a targeted list of companies.
Yeah, exactly. Agree with you 100% there, Hari. What else? I think the magic formula is a very powerful tool, and as we talked about it, as Hari talked about with the back test, it yielded really good performance for at least past 20 years. 20 years or 10 years? Was it 20 years?
20 years.
20 years, yeah. 20 years with the recession in there, right? Yep. You got big recession in 08, 09. The compounded annual growth rate of above 25%, 24%. That's pretty astounding returns right there. So it just tells you that this is a fertile ground to look for really good investments. And if you pick the right one, your return, it doesn't have to be 24%. It can be 50%. It could be 60%. It could be 40%, like Greenblatt himself, has done for the past 30 years. So again, I think this is a good filtering mechanism, and it's a good fertile ground to look for good opportunities, like Hari said.
Yep.
All right. I think that's it for us. Anything else you want to add real quick?
No, like I said, we have a lot of things that are coming up. As Becco mentioned, one of those is a website to help you start your own process for investing and looking up companies. We're hoping that we'll be able to get that running by the end of the summer. So if you want to be notified, obviously we will also mention it on the podcast, but if you want to be notified when it comes out, send us an email, info@valueinvestor.org.
Anything else you want to add, Hari?
Yeah, I think Becco had mentioned that we're trying to launch this website. We're hoping to get it up and running by the end of summer 2019. If you are interested and want to have access to it, send us an email, info@valueinvestor.org. We'll also mention it on the podcast when it becomes available, and probably do a whole podcast on it, just to help you understand what's on there. But we're really excited about this. This, I think, will be a great tool to help people find good investments, to help them research them. Obviously, you'll have to still do your own work afterwards, but I think it's a great place to start looking for potential investments. We will probably also include on that website some other exciting things that we are, not just a database of stocks, but some of our own lists that we create. So we're excited to bring that to you guys. So stay tuned. Yeah,
exciting times ahead, guys. Again, thank you all for listening. I know a lot of you guys sent us emails and Twitter And all those comments are really helpful for us. So keep them coming. Keep asking questions. We want to get this community going of value investors online. So again, thank you all for listening, and I'll see you on the next one.
Yeah, thank you.
Thanks, guys.